Our topic today is the bond market outlook, assembling the puzzle. Michael Branos, who's sitting next to me here, is the founder and chief executive officer of Ellington Management Group. He founded Ellington in '94 to capitalize on distressed conditions in the mortgage-backed security derivatives market. Previously, Mike was the senior managing director at Kidder Peabody in charge of residential mortgage-backed securities trading, and built Kidder's efforts in that area to a really leading position. Then we have, sitting next to Michael, we have Teresa Havel of Havel Capital Management. Teresa founded her firm several years ago with a focus on investing in fixed income markets. Teresa previously was responsible for the establishment and management of Newberg & Berman's fixed income group, where she was chief investment officer. Teresa, thank you for joining us. And sitting next to Teresa is Morris Offit, who is chief executive officer of Offit Bank, a Wachovia company. Morris founded the predecessor firm in '83, and previously was at Solomon, where he was a general partner and was responsible for the worldwide fixed income and equity sales in the stock research department. So let me first turn it over to Morris. And I noticed yesterday that President-elect George W. Bush, in announcing his new Treasury Secretary, said that, I think he said, we will play the hand that we've been dealt. And maybe you could tell us, from your perspective, what that hand is and what he's facing and what Treasury is facing, what the rest of us are facing as investors in the fixed income world.
Yeah, thanks, Ryan. Good to be back. That's a cryptic comment, and I'm not quite sure what President-elect really meant, or who said it, George W. or O'Neill? Who made that comment?
I think it was George W.
George W. I don't mean to be disrespectful, President-elect. I don't know. I think whatever he thinks he was dealt, it's going to be a whole lot worse, to tell you the truth. This is one of these periods in time where you don't have to be terribly prophetic about the bond market, because there's just absolute certainty that rates will continue to move lower, and it's all kind of written before you, in our opinion. I should preface that, because I'm not quite sure what my co-panelists will have to say. Excuse me for being so declarative about my feelings. So therefore, my comments can be sort of brief. The point is that we've been on this tack of lower interest rates for quite some time at Offit Bank. And what I have before you, I gave you some yield curves, and I hope everybody has a copy of this sheet. Maybe I didn't bring enough. I don't have any more. If people could share at the table and pass a few back to the backbenchers, that would be helpful. Thank you. You'll see some cryptic dates here of beginning with March the 3rd. And the reason we use that date is because, well, March the 3rd, we came out with one of our commentaries, which we write just for our clients. This is not really for public consumption. And we entitled the commentary, "Bond Yields Are Peaking." So in early March, we felt very strongly that the outlook for interest rates was going to be much, much lower. And why in the world did we come out with such a strong statement at that time in March? And the reason was of course, the inversion in the yield curve. And there's a very, very strong correlation between the inversion in the yield curve and the outlook for interest rates. The reason is that the Fed sends the signal to the banking system through the Fed funds rate. And that's all it is a signal, because the Fed can't do anything more than that. And it was up to the banking system as the transmission vehicle to whether or not it wanted to follow up on this. The point is that the banking system, again, which is the engine, and, as I said, the transmission vehicle. There's an old adage, and excuse the vernacular, but don't screw with the banking system. If the banking system really wants to start to constrict the extension and the creation of credit, in effect, that will lead to slower growth. And there was absolutely no doubt in our mind, and here, of course, Offutt Bank had merged into Wachovia, and I asked my Wachovia colleagues how they felt about this, and they chose not to comment. But we had such definiteness about our opinion that the banking system was going to slow credit creation, and the banking system was going to be a lot more rigorous with respect to credit standards, that this was absolutely a slow credit creation. And this would mean slower growth. You saw it in the capital markets. You knew that the high-yield credits couldn't finance. You started to see the shrinkage of and the pullback from the bankers, what they could do in order to get deals done in the marketplace. And if there's one thing you have to realize about the marketplace, the one operative word all the time is linkage. And if something's happening over here, there is an effect over here. And that's the job of the analyst, of course, to, in effect, understand the implications of one act and how that kind of permeates everything going on over here. And you knew once the capital markets were under pressure that the banking system was pulling back, and you knew companies couldn't finance anymore. In effect, the economy had to slow. So you see that inversion in the yield curve in March. Then on June the 5th, we came out with a comment. Our next, and by the way, I had 10 sets of these commentaries for anybody. I do have some extra copies. The reason I'm so promotional here, it's very rare in life that you're right for the right reason. So I want to take advantage of it, because when I come back, I may have egg all over my face. But anyway, I mean, Ralph knows me and others, and I just feel if I'm asked to speak to you, I'm going to lay it all out as we see it, and with our absolute candor. The next commentary was the inverted yield curve is working, meaning that, in effect, growth was slowing. And the most important thing was there was now some indication from the standpoint of availability of credit. The Fed does this little census taking among the commercial bank officers. And in other words, are you tightening your standards? Are you willing to make consumer installment loans? And they all had, in effect, a declining response to that. So that was further confirmation. And then in October, we said yield curve inversion ending, credit rationing accelerating, slower growth beginning. So that was in October, and the most important phrase, of course, was credit rationing accelerating. And again, that's what's being played out in the marketplace. And now we have a commentary that's going to be coming out in the next 2 weeks. I don't like the title, but it's about slower growth. But you got to realize that when you go from growth levels of 5% down to 1%, and you still have so-called growth, that's a deceleration. That's not much different than going from 2% plus growth to a minus 2% or a recession. It's still a deceleration any way you look at it. It just depends on your levels. So this kind of deceleration in the economy, and as a matter of fact, I don't even think you're going to have growth. I think with what's going on, we will have a recession as characterized by the Fed. So rates are going to come down a whole lot more than people think. And the key here is the outlook for capital expenditures, which you have to realize more than anything else, it was the CapEx as a percentage of GDP that really propelled this economy, going from 7.5% up to 9% plus of GDP, a very large percent of financial assets generally. The slowdown in your CapEx numbers are really going to unnerve the economy. And this is where the stock market has an impact. Believe it or not, everybody looks at the stock market impact on consumer behavior. It's as much behavior on businesses as it is on the consumer. So for us and for you as well, we would say the telltale evidence, the key indicator will be capital expenditures, that particular number. Now, having said all this and looking, say, for 10-year Treasury, certainly below 4.5%, we said this a few weeks ago, and when it was 5.5%, it looked like it was an outlandish kind of outlook. Today, 4.5% looks very much in range. So you have to say, where else is there value in the fixed income marketplace? The spread product is going to come back in favor. And, of course, one of our colleagues on the West Coast has been very, very adamant about not owning any corporates at all because of deteriorating credit. That's all being played out in the marketplace. You're not telling the marketplace anything new. High-grade corporates against treasuries, you've opened up those yield levels from 50, 60 to 150, up to 200 basis points in some instances. The high-yield sector, where we do a great deal of work, you are talking 8.5%, 9% now, up to 11%, 12%. So that the spreads and paper that we feel is very much money-good paper, the spreads now will be some 600, 700, 800 basis points as to what you can do. And if you can't buy that kind of paper and feel comfortable, then in effect you're saying that there's going to be extraordinary devastation to the stock market. Because if you're going to have the kind of carnage that terribly impacts that paper with that kind of yield cushion, you're saying the whole marketplace is going to be under extraordinary pressure. So the arithmetic of buying high yield today certainly works in your favor, and we could go through that analysis with you. One other spread product before I close, which is this little niche, and here I am being promotional because we do a lot of work in this area, is in the dollar-denominated, for example, Latin American credits. You have a number of Brazilian, Mexican credits, corporations that we feel are very, very creditworthy, and I'm only talking about dollar-denominated paper, yielding 13 and 14%. And it's a little niche. Very few people know anything about it. There are only about 4 or 5 of us in the marketplace that really do the homework, and I'm only talking about corporates, not talking about sovereigns, but corporates that we feel are extremely creditworthy, where you can really do the homework. If these were U.S.-based corporations, they'd be a lot more appreciated in the marketplace, but these are companies that do business in the U.S. but just have the wrong home address. But there are some sectors in the marketplace that have a lot of appeal in today's kind of array of product. But in closing, I would say that there's every evidence in the world that the economic slowdown is going to be a whole lot greater than initial expectations. Rates are going to go a whole lot lower than initial expectations, and it's one of these rare times that you can buy bonds really with a great deal of confidence. Thank you.
Morris, thank you very much. Mike, you've got a certain perspective on these issues. What are you seeing from your vantage point?
Well, I just wanted to sort of echo a bit of what Morris and Teresa said. I mean, they're both talking about spread product here. Morris commented about bank credit tightening. And I think most of the spread product which panelists have been referring to have been a corporate spread product. And although I do agree that, spreads are very wide for corporate debt right now, there is a sector of the fixed income market that's already come full cycle to where the crash has already occurred, defaults are already occurring and already priced in very conservatively, and that's in the consumer debt markets. So I think everyone here is always looking for distressed situations, and people go far and wide over to Japan and such to look for the greatest distressed situations, for hedge funds and other investors. And a very great distressed situation is actually occurring right now in the United States in consumer debt product. And I want to talk specifically about mortgage debt. I want to talk about what I call subprime mortgage debt. And just to give you a quick overview of the mortgage market, and really quick, the residential mortgage market is about $4.9 trillion in size. about $3 trillion of that is securitized. Now, a subsector of that market, going away from jumbo loans, which are for rather wealthy homeowners, and conforming loans that are underwritten by the agencies, Freddie Mac, Fannie Mae, and Ginnie Mae, there is a smaller market, small by mortgage market terms, of about 400 to 500 billion in size, almost a half a trillion, which is the subprime market. And I want to talk a little bit about the shakeout that's already occurred and is occurring now, but in that market. When I talk about subprime, and everybody, it's sort of a generic term, I'm talking about, let's say, we'll talk about B and C credit quality loans, homeowners with less than pristine FICO scores that don't qualify for A loans under the government programs or jumbo programs. There are some second lien mortgages. By and large, what I'm talking about today are first liens. High loan to value mortgages, where the loan value approaches the value of the property, or may even be greater than that in the case of debt consolidation for consumer. Manufactured housing product, for example, mobile homes, things like that. This whole market is close to $500 billion in size, and it's feeling the effects of the excesses of the mid to late 90s that some of the specialty finance companies have got themselves into. This explosive growth didn't come without a large price to pay for certain of these specialty finance companies. In fact, most of them. I think you may know some of the names: Ames, Conti, First Plus, United Companies, and of course the Money Store, which First Union purchased and then subsequently closed and took a $2.8 billion write-down of in June. There are severe liquidity constraints put upon these companies right now, and those constraints will only become more severe next year as capital regulations are increased, capital haircuts are increased for the securities that they have retained. So let me talk a little bit about what it is that what happened to these companies, what it is that they did, and then tell you about the securities that are for sale in the market now as a result of all this. Basically, these consumer finance companies, specialty finance companies, had originated a lot of these B and C loans through the mid to late 90s, and using gain on sale accounting, booked some of the first loss and lower credit quality pieces at very aggressive levels, and did show, as a result of that, gains on their books, and then went to the equity markets to raise more capital, and it was sort of like a non-sustaining game that, as I mentioned here, crashed recently. As a result of that, and as a result of increased regulatory capital charges that are occurring now, these companies are forced to book their securities at much more conservative assumptions. I just have a chart here, and I didn't bring much of handouts or anything like that, but a lot of these securities have been written down 50 or 60% in value and still need to be sold. And we have seen these securities already in the market for the last 6 months, and it's no exaggeration to say that practically no one is buying these, and that and I'll talk a little bit about why that is. The first reason, and the most important reason, is that there are incredible barriers to entry into this business. What goes into valuing, purchasing, and managing these securities is it's an unbelievable task. Where first these securities, they're booked as first loss pieces from securitizations of this B and C collateral. They act in effect as a cash flow, the bottom cushion cash flow provider for the upper tranches. There are reserve accounts, triggers. Some of the deals are very complicated. The loans themselves, there are different types of loans, and each of these types of loans have their own default and prepayment characteristics. So one needs to have done a fair amount of modeling on a large amount of data to project prepayment and loss experience for these loans going forward, and then to project what would be even more conservative than situations, or more aggressive on the default side than what we're seeing now, to make sure that these securities can maintain their rather large spread in the case of a greater recession or a greater default for these homes. Now, keep in mind, these homes, these mortgages, are mortgages of the size of between $70,000 and $150,000, and we talk. People have sure remembered some of the real estate crises of the United States over the last 20 years, and those crises have been quite regional. Although I did not bring a handout, I will say that and from 90 to 95, the national average for home prices actually rose 5%, whereas in California, in certain sectors of California, we saw a 35% decline in home prices. In 84 to 88, we had the Texas scenario, which was a 40% loss in home prices, decline in home prices, against a 20% increase in national home prices over that period. New England, 88 to 90, 20% loss, whereas national home prices were pretty much unchanged from 88 to 90. The point is basically that these securities that I'm talking about are backed by a huge number of loans, and and a fund or any manager that would purchase securities that are backed by these loans may ultimately end up owning a beneficial interest in 50 or 60,000 loans. And you have the law of large numbers working for you. Your data works for you when you have that many loans behind you. You have geographic diversity, and you are fairly well insulated against what has been, on a national level, over the past 20 years, very little times where housing prices have dropped at all. And that's not to say that it can occur or that these securities couldn't be priced to still yield double digits in the case of a decline over a long period of time. They can be, but it is a strong feature of owning these securities that you have the law of large numbers working for you. Now, when I talk about the fact that we have all these loans, another barrier to entry is the fact that once these assets are purchased, it takes a tremendous amount of work to manage these assets because all the loans need to be serviced. So one needs to have an alliance with a top-ranked special servicer to make sure that each of these loans, especially, of course, the sub or non-performing loans, have attained the greatest value for the benefit of the servicer, of the security owner. So let me just get to the punchline. When we look at these securities now, and we look at our relatively aggressive, I don't know whether to use the word aggressive or conservative, but let's say high default scenarios greater than what's occurring now, and what is projected to occur given the loss curves and the default curves that we have regressed against using our models, that on an unlevered basis, these securities approached a 20% return. And financing is available, and I think another strong point about owning these securities is that one does not have to rely to a great degree on the capital markets for financing. Even with extremely modest leverage, I don't think that it's pretty simple math that you can get some very high returns. I think one of One of the negatives about these investments, which you probably already would have guessed, is that they're extremely illiquid, and it's both good and bad when you go to one of these specialty finance companies, or in the case now when they come to us looking for a bid, because the safety net has already been broken. There's no more First Union to buy out any more of these troubled companies, and there's nobody else looking for these securities. And I'm not speaking about the equity values of these specialty finance companies, and I'm not touting them, and I really have no interest personally in owning or operating that business. But I think with the security, the same thing goes for the residual interests of these securitizations that are owned by these companies. There are very, very few buyers, and one needs to take a very long-term approach in owning and managing these securities. You cannot, unlike in the case of perhaps corporate debt, now earn a decent spread, nothing compared to these securities, but then with the hope that you could turn around and sell when the cycle moves in your favor. It's very likely that that a year down the road or something like that, even after these securities have performed well, that it'll be very difficult to sell them. On the other hand, many of these securities have extremely short cash flow durations. In some cases, under the assumptions we're using, you're getting your money back in 2 to 2.5 years. So even if a down cycle, a down cycle beyond which we've projected would occur in home values and ultimately to the detriment of the bondholder, this cycle takes a while to occur. The ultimate foreclosure and sale of a home takes a good year and a half. Throughout that period of time, you are receiving interest and sometimes principal on these securities. So from a standpoint of where we are in the cycle, I think you're pretty well protected. Now, when I did talk about the market, the size of the B and C market, the only thing I neglected to mention is the size of some of these distressed securities. Of course, because they represent the lower cushion on these securitizations, they are a rather small percentage of that whole market, probably somewhere in total size between 15 and 20 billion. And a lot of them are out there looking for a home now. So I guess in summary, if you have any interest in this, I'm not really here to sell our expertise in particular, but we are in the market now looking around. We've partnered up with a servicer. I think Lisa has left the one-pager you can pick up on the way out. So thank you.
Thank you, Mike. Teresa, you've got a uniquely global approach to the markets. What's your perspective?
Well, first of all, let me just say I am absolutely thrilled to be here. And for the audience who doesn't know how much I have pestered Ron to say, why don't you put more bond educational programs on your calendar? I'm so thankful that this is the moment that finally he chose, because I think it's a very opportune moment to be here to talk about fixed income. And, I'm enormously excited about the prospects in fixed income, not without reservations, because we are going through an extraordinary period for capital markets in general, and some of those features are absolutely unique for fixed income. So, I want to really carry on and add on to what Morris has said, but in the light of that, I have prepared some materials for you. I think that the time will not allow us to go through all of these. So I'm going to leave those with you, and I'm going to go through a few of them, and then I've left some written documentation that you can pick up on your way out, and you can follow through with this. I have been managing fixed income securities for there's a dead giveaway on my age, so I think it's going now 30 years, something like that now, 20 in the 20 years, 25 years. I think it's since I've been working for 30 years, but I've been actually managing debt securities for 25 years, and I have never seen a period as extraordinary as the one that we are facing today. And so, given that the backdrop of extraordinary times call for extraordinary measures, we have written, Havel Capital, we have just written a paper about what we see as extraordinary opportunities and extraordinary dislocations in the marketplace. So I thought, for the benefit of education, I would like to give you an insight into what we are thinking, what we are seeing. I know some of you are investors, some of you are participants in the marketplace, but everyone has like a different vantage point. And for you to see it from our vantage point, I thought that would be important. I am going to agree with many things that Morris said and probably disagree with some of those, and the same thing with my colleague, Mike. So if you turn to your booklets, these are the points that I want to make. That today I'm not here to mince words. It is an extraordinary time in the marketplace, and if I can go away leaving these 4 points with you, there is plenty of time for you to study and elaborate on that. The first point is turmoil in the credit markets. We are in a period of turmoil. There are credit dislocations. There are pockets of tremendous illiquidity. There are discrepancies in prices that we have not seen in my tenure in the modern bond market. What's the following point from turmoil is opportunity. I am here to tell you that I believe that today represents the best opportunity for non-treasury fixed income securities that we have seen in a decade. There are some truly extraordinary opportunities out there that one should look at. This is in the light of the fact that over the long term, we know that fixed income securities are indeed competitive with equities when they're put on an equal footing with their risk characteristics. We have moved vastly away from that model in the last 4 or 5 years, and I believe that we are on the precipice of moving back towards the normalization of the model. So fixed income securities are going to resume their relative returns vis-a-vis equities, and that is unfolding as we speak now. And finally, I think I wrote this a little bit before, certainly before the events of yesterday and the day before, but I think we are definitely seeing the close of the period of the free lunch, where riskier securities outperformed and gave you high performance with less risk. So we are seeing the closing of the period of excess performance for riskier stock market indices. Rolling the dice is not working anymore in the equity markets. Those are the points I want to make. Let's just look at a little bit. If you turn, I want to show you just a few of the charts, and then we can, turn it over to question and answer. One of my problems is I love to talk about the bond market, so Ron will cut me off, and I have to be cognizant of how far I take you here. To understand the capital markets, you need to take a long-term view. And so this sort of busy risk return chart gives you the long-term view of where fixed income stands vis-a-vis equities. All of us being bond managers know that our position is in the back. I'm sure you all came today just because you heard there were going to be sports stars here. He really sent out the invitations, not inviting you as bond managers. But the fact is that bonds are not a low-performing, high-risk asset category. They have excellent risk-return characteristics, and they're very competitive with equities when you look at them in their proper mode. The point that I want to make here is that U.S. bonds have had exceptional returns for the level of risk, and that they are very competitive with equities, and that they've had superior risk return characteristics to the riskier equity indices. You won't be able to read the numbers as carefully as I do. I have a little cheat here, so I'd just like to tell you a couple of the statistics here that over this 20-year period, triple B, for example, or single A rated bonds have delivered somewhere between 70 and 73% of the return of the S&P, with between 42 and 45% of the volatility. So on a risk-adjusted basis, bonds are very much there. Bonds can be leveraged. Their risk characteristics can be easily tweaked. We know that. Many of you have heard me speak about how to run diversified portfolios, balancing off the 4 different types of credit: duration, volatility, and currency risk. But even on a standalone basis, corporate bonds to the S&P, to a basket of companies, compares very favorably. If you look at those same returns and you compare them to the NASDAQ over the long period of time, the corporate bonds, the A and triple B rated bonds, have delivered 82% of the return of the NASDAQ with only 28% of the risk. So it's been very good over the long term. However, if you turn to the next page, since 1997, the model has been broken. Things have gone greatly astray. There has been extreme stress in the bond market. We are warriors just surviving. 1997, we had the Asian crisis. My first introduction to the Greenwich Roundtable was in June of 1998. I came as a guest of Juan Mayer's here and heard very good presentations. Russia had just finished some successful debt offerings and had repaid bridge loans. Things were looking great. And 6 weeks after that, all hell broke loose. So we know that 97 was the Asian crisis, 98 the Russian crisis, the long-term capital crisis, and 2000 has been a liquidity and a credit crunch crisis. Since 1997, and this is what's wrong in the bond market and what will change, is that treasuries have outperformed investment-grade bonds with lower risk. B-rated bonds have underperformed double B bonds by almost 6%. Since 1997 with higher risk. So our whole world has been turned upside down for the last 3 years. And I would submit to you today that we are going to be in the process of cleansing the system of those unusually out of balance returns. Pushing on a little bit forward, if you look at what the long-term excess return of the S&P over the broad index has been over the last 20 years, it's been about 4.5% per annum. However, there are two distinct time periods here. There was then and there was now. From 1980 to 1994, the excess return of the S&P over the bond index was only 0.8% per annum. But since 1994, equities have been outperforming bonds by 13.5% per year. I understand why nobody has wanted to buy bonds, because that is extraordinary. The market has been totally bifurcated. Again, the point that we're making is that we're going to come back to the norm. Again, if you turn the page, we have a chart of the investment-grade corporate bonds vis-a-vis treasuries on a rolling 3-year period. You can see here that for the first time since the data is available in the early 80s, on a 3-year period, investment-grade bonds have underperformed treasuries. We have never had that. So what Morris is saying, treasuries have rallied. They have responded to a slowing economy. Corporate market is standing there at the widest spreads and the lowest performance that we have seen since the 1980s. Over this period, investment-grade bonds have, over the last 3-year period, they've underperformed treasuries by 1.37%, and their Sharpe ratios have fallen to 0.18, where treasury Sharpe ratio is 0.55. So we've had exceptionally poor performance that is in the process of correcting. I'm going to ask you to skip one, and because I know we're not going to have too much time. Let's talk a little bit about emerging markets. You saw how credit markets, how U.S. corporate markets have underperformed. In emerging markets, we know that emerging markets, since the inception of that market, and by that I'm talking about sovereign credits, they've outperformed treasuries by 8% per annum since 1990. However, in that 8% aggregate number, they have underperformed treasuries by 1.35% since the Asian crisis. So again, we have seen a gigantic dislocation take place in the market. So what is happening? Prices of those sectors are going down while prices of the treasury sector are going up. It's been truly dramatic. Let's talk a little bit about this, and I also took the opportunity to give you in your package an article that was, I was interviewed in Barron's, and I talked a lot. Barron's editor asked me a lot about the dislocation between Treasury and corporate spread, so I thought that would be interesting for you to look back at. And as you can see, that the correlation between corporate and Treasury market has broken down sharply in the last 2 years. Here are the long-term correlations and then the short-term correlations. Now, what has happened in the market is twofold. First of all, as you know, the Treasury has bought back Treasury securities, so has reduced the supply, although given where we are now, most people believe that will be temporary. And secondly, the inversion of the curve has also caused the correlation to break down. So the Fed has raised short-term interest rates and created an inverted curve and made that dislocation even greater. Now, the next thing that I want to point to, I think, is the most sobering of the charts. I, by definition, am an optimist and believe we will come through this. But I think that we all should look carefully at this next to last chart that I have, because this shows you the breakdown between the swap curve and the government corporate curve. The swap curve being the generic rate for financing and the corporate curve. Normally, those two curves are very much in line, but we've also seen a breakdown in that. And what I believe and what my partners believe is that while this breakdown is not indicating a recession, is showing a slowdown, is showing that the slowdown in the economy, while it may not go into negative territory, is so significant. So it's going from 5+% growth to something under 2. That is the same kind, is creating the same kinds of dislocations that you might have if you were actually going into a recession. So the market is saying in the individual swap curve, which is generic, we're not seeing the true reflection of the pessimism in the market. But in the credit curve, and particularly in the high yield curve, which Morris mentioned, we are seeing that. The market is very, very shrewd. The market is saying something is not right here. We see, although no one is forecasting recession, we're seeing such a change in the rate of growth from so high to so much more moderate that it's having the same effect on credit curve. And that's why we've seen that dramatic breakdown between the swap curve and the corporate curve. I think that is the one, if people had been watching that, they would have seen what was happening in the equity market. That was the single most given little attention or no attention in the press, no attention in the CNBCs of this world or the CNN-FMs of this world, but certainly, a number to watch. I'm not going to end this, though, on bearishness, because you know where I'm coming. I'm saying that we are going to see a reversion. We are going to see a period where yes, a few credits. Market excesses always bring excesses. There are some companies that will go out and some high-yield bonds will default. But in general, we will see the normalization of the spread. We will see the market begin to regain its footing, and that will bring those long-term relationships back to where we've seen them. Things always come around. The cycle always repeats itself. So I want to leave you with the sense that I'm not trying to sell, but to educate that this is truly an extraordinary period. We have never seen spreads as wide as they are, and with reason to believe that they're going to go lower. Let's talk just a little bit on the interest rate forecast, because while I would have to temper what Morris said with some more moderation. I believe that if the Fed will indeed begin to pursue a course of lowering interest rates probably as early as January of next year, but given where we are and given how far the Treasury market has come, in light of the fact of that the anticipation of the end of tightening and the anticipation of the beginning of easing and the end of the buyback of Treasury securities, the Treasury securities, again, fixed income markets they're more clever than equity people. They saw this coming before. They've already moved the Treasury market. The Treasury market is just like 1998. We've had it most of it. In 1998, the Treasury market peaked on September 6th And that's what, it was all over by then, and from then rates went straight higher. And this time, I believe the Treasury market is approaching its equilibrium, its threshold level. So what are we going to see? We're going to see the Fed funds rate coming down, but the Treasury market has already moved there. So where do you want to look? You want to look to a spread product, which has been dramatically out of favor for the last 3 years. We've never had a period like that where we can show you over rolling 3 years that investment-grade corporate securities outperforming Treasury securities. That's an anomaly in the market. That's going to correct itself. So the money to be made is not in Treasuries unless you're a shrewd trader, but it's looking towards the spreads and obviously avoiding defaults. From a perspective and a philosophical point of view, my firm believes that the best way to avoid the pitfalls of the market is to not try to reach for the top of the market and to produce a portfolio that diversifies the risk. The best way to diversify the risk is to spread it out over the 4 features of fixed income, which are credit, duration, volatility, and currency. So if you build a portfolio that has a moderate amount of credit exposure, a moderate amount of duration exposure, a moderate amount of volatility exposure, and a moderate amount of currency exposure, you will have captured all of the components of fixed income, and you can do that in a diversified or a moderately leveraged way, and that will allow you to take advantage of the opportunities in a prudent fashion. A single shot at, I'm going to argue against a single shot at one sector is putting all your bets on one sector. And I remember being here in 1998 when none of us could guess which sector was going to perform and which sector was going to underperform. None of us can predict that kind of certainty. And so taking the top off to spare yourself the bottom is the best approach. Good luck for 2001.
Thank you, Teresa. Are there any questions or comments? Yeah, here, please.
I think this question is better directed to Teresa and Morris. Some people, ourselves included, have a fundamental view on the high-yield market, and that is that default rates will continue to go up. Perhaps over the next 2 years, maybe a year and a half or so, things are going to get worse before they get better. When you express your view that perhaps now might be a good time to be buying, is that based more on the technicals of the high-yield market, or do you have a fundamental view?
Some of both. What I said is that I would be a diversified buyer. I wouldn't put all the money in one sector. Mortgages are obviously very attractive. Pass-throughs, right down to credit-sensitive mortgages. Single A corporates, right down to double B high yield. So you need a combination of both. You need a combination of astute security picking to be able to avail yourself of a cyclical opportunity. You can be less than an astute, security picker and buy agency pass-throughs, which are still wide because of the credit, because of the Treasury corporate or credit swap spread, the dislocation there. But you definitely need to be a very shrewd picker, and I by no means believe that we are finished with the demise of the high yield market. The high yield market is closed right now. They have no access to capital, and so many of the issuers that Wall Street brought that might be viable under, in fact, one of the strongest selling points that Wall Street made in their roadshows, in their selling presentations, was that, here's a great telecom company. They have quote unquote unlimited access to capital. We can come back to you and we can sell you another bond issue. And that was oftentimes number one on their bullet point. That bullet point has been scratched. They have no access to capital, so they're just in a burn situation. Other companies are going to be completely viable, but that is definitely, while the market remains closed and until we get to the next froth, it's definitely a securities picker's market. It's not just, take a broad, or you take such a broad, diversified approach that you can afford to have, the normal, the extraordinary default rate in there. So you have to have room If you're not a very, very shrewd picker, you have to have extreme diversification so you have room for an extraordinary default rate in there. But if you juxtapose that with other types of securities that give you spread product is wide, not only in the credit-sensitive area. It's wide because, as we said, the Treasury curve is inverted, and Treasuries have been in great demand because of their scarcity value. So there are a number of features that are making credit spreads wide, not just credit sensitivity.
I think most people do expect default rate to go higher, and it probably will, just because how the high-yield market has been skewed by virtue of the issuance of all the telecom paper, and so you'll have a high default rate there. But if you adjust for that factor, and if you adjust for the bizarre situation of the asbestos-related claim situation, the Armstrong Cork common stock paying a $2 dividend a few months back, a BBB rated security, and it's the fastest bankruptcy on record. In going from that level of so-called investment grade, if you adjust for those two factors, asbestos-related and the large telecom, it's hard to see where you're going to see high default rates. And right now the market is expecting 8, 9, 10% default rate. Be nowhere near that, and if you can hold these securities for 3 years, and if it's high yield versus treasuries, not high yield versus common stocks. I'm thinking of high yield as a fixed income surrogate proxy for the fixed income market, so I'm not relating it to the common stock market because we specialize in the BB end of the high yield, and when you say high yield, you have to make adjustment for all the sub-markets, because there are 5 or 6 grade different differentials between the BB down to the CCC being distressed, which has all the volatility characteristics of common stocks, whereas BBs would have volatility characteristics of a fixed income instrument. And that's where we are over here, not over here. If you make all those adjustments, you would have to say that every default rate consideration, every so-called worst-case scenario is reflected in today's spread analysis, and I can go through all that arithmetic with you on that. But again, you got to realize what had happened in the telecom area and also the asbestos.
I'd like to add one other comment about that. In the high yield area, liquidity is such a critical negative right now that one variable that we must take into consideration is that it's a market that up until about November was able to meet its outflows from open-end, one-day delivery mutual funds with its coupon payments. So, there was a delicate balance that was at work. Funds could meet their outflows that way. Since outflows have turned much more sharply negative, funds, and that brings into question whether the open-end mutual fund is really the appropriate vehicle for such a risky security. As Mike pointed out, you need to have the luxury of time. You need to have the luxury of investors prepared to take less liquidity. But if your investors say, I want liquidity now, the prices that are in the market will not hold. We have had tremendous consolidation in the market-making industry. So where we used to have 10 or 15 market makers, we only have a few. We have studied, in the piece that I've handed out, we have studied the balance sheets of the broker-dealer community. They are committing less capital. They are holding smaller inventory than any time in the last decade. So they are not there to support the outflows. So if we have that, we could find that prices of mutual funds are totally unrealistic as they're pricing them now, should they really need to. A point in question, a little far away from that, but it's the Heartland High Yield Muni Fund. This was a high yield muni fund that was bumping along, producing nice income, nice NAV, and then one day the investors decided to leave. And when the investors decided to leave, the NAV fell. This is an extreme example, and it's under SEC investigation, but the NAV fell like 70% because the market, even though the prices might have been realistic for the securities, the market wasn't there. And the ultimate test of the market is what price will someone make you at the time that you need to sell.
Just wait. 1 second. Just wait for the mic to come around if you don't mind. Sorry.
Two questions for the panel. International. I guess the first question I have is, there's an assumption that the differential growth rates between the U.S. and Europe are going to come in next year. Notwithstanding the political economics of the ECB and Mr. Duesenberg, what opportunities do you see in international fixed income in Europe, perhaps, and perhaps Argentina post-bailout? And secondly, Mike, there was a comment in yesterday's paper regarding Treasury pricing rallies in terms of mortgage backs coverage and whatnot. Are we in for another refi cycle? Is that possible?
Start with international?
I'll start with the international. Your two separate questions, Argentina, which is dollar denominated for the most part, and Europe. Yes, I think there is going to be an opportunity. Remember, I said, in bonds there are four variables: credit, duration, volatility, currency. So there's going to be a double-edged or a double whammy opportunity. European rates, growth rates, and U.S. growth rates are going to converge. So we will be seeing lower interest rates probably in Europe, combined with a strengthening euro. We have seen the euro now strengthen from 84 to touching about 90. That trend is underway. I think it's going to be very gradual, but we are definitely seeing a shift away from the dollar. So you're going to get the possibility of having, good returns from the underlying bonds as well as from the euro there. And on Argentina, as everyone knows, that the IMF came up with a $38 billion combination package to bridge the economic difficulties that Argentina has been experiencing. Much of, or not, I want to say all of Argentina's difficulties, but a considerable part of Argentina's difficulties, we can trace them to the same factors that produced the Asian crisis. Argentina has a dollar peg. They have been pegged to an increasingly stronger dollar. And as the dollar has strengthened against Europe and as the dollar has strengthened against Japan, it has put them in a very, very tight money position. So they've got two things going for them now. They've got a package to bridge themselves, and we have a dollar where the pressure is coming off them there. So Argentina is, definitely going to, is improving now, and that will improve. There will be some spillover that we are already feeling that in Brazil and Mexico, which is an investment grade credit. So what's good for that large country in South America is good for countries in South America in general, and it's good for the U.S. because these are our neighboring countries. So both of those represent good opportunities.
Three quick points. No value at all in European interest rates. U.S. is where you ought to be. Number two, euro over time will continue to weaken against the dollar for a lot of sociological reasons, which I could discuss with you. I gave that speech in Berlin a few weeks ago. Third, Argentina, sovereign credit risk, no interest, however, tremendous interest in some of the corporates in Argentina, dollar-denominated. A company called Disco, the largest supermarket chain in Argentina, 50% owned by Ahold, a AA-rated credit out of the Netherlands. As I said, dollar-denominated yield level is 13%. For a very, very high-grade corporate credit in Argentina. Cablevisión, outstanding, excuse my Spanish, outstanding cable system, the leading system in Argentina. It's the value today of what a steel company was worth 30 years ago, as being, in effect, the absolute guts of an economy, worth a tremendous amount of money, and that debt is yielding 13-14%. So you have these one-off type situations in Argentina, any one of these countries. Again, it's the corporates, and it's the situation where the underlying corporate securities are worth a whole lot more than the sovereigns. However, the rating agencies, Moody's and S&P, have the glass ceiling and will not rate a corporate credit any higher than that rating enjoyed by the sovereign. But in many cases, the corporate does have more value than the sovereign. So it's the kind of convoluted thinking where you can make money in the market.
Mike, you have your choice: the euro, Argentina, or mortgages. What do you want?
Talk a little bit, real briefly, answer your question about the possible refi cycle. In some ways, like if you look at 1998, the first major refi cycle in '98 occurred in the spring as a result of the winter rally of '97, and it was quite a surprise to many mortgage market participants. Whereas the rally again in the summer of '98 and into September was much more of a treasury rally. And as you know, homeowners fund themselves or get their mortgage rate is determined by the agencies whose rate is more determined by where swaps are than where treasuries are. So first of all, swap spreads, although they've come in a bit, are still relatively wide compared to what we saw a few years ago. And therefore the mortgage funding rate is wide to treasuries. Also, implied volatility, the expected variance of rates, is very high right now. It's come up quite a bit, and as a result of that, that is a negative that makes the mortgage rate go up also. So for those factors, we see that the mortgage rate isn't as low as it could be given where treasury rates are, or even given where swap rates are. We will see tremendous refinancing levels on certain securities. That which is above par will continue to pay very quickly like it has in the past. However, that'll be tempered by the fact that the mortgage rate could still drop some more, and that there is, because I think some of the underwriting guidelines of the agencies have been a little bit more lax, you will see some less than pristine credits even in the mortgage pass-throughs, though where it's all guaranteed by the government, but it's a little harder for some of these people to refinance. So that's the answer to your question. I wanted to bring up one other point, and maybe Teresa and Morris can comment on this, but with regard to the high-yield market and also to the asset-backed market, but more to the high-yield market, there's been a tremendous there's just been a tremendous issuance of CBOs, and a lot of the equity pieces of the CBOs have been sold given extremely aggressive assumptions on defaults, 2% per annum or something like that. These CBOs are already biting the dust. It's carnage for high yield, and I think for some asset backs it may be coming. But I think primarily it's going to be a high yield problem, and this takes a tremendous bid out of the market for that product when originators can no longer originate, buyers turn sellers, which we've already seen. And that doesn't have anything to do necessarily with the fundamental value of the high-yield market, but it's a technical, and I think it's a negative technical.
Yeah, you're absolutely right, Mike. The equity portions of the CBOs, I believe, have been nearly wiped out now in many cases.
And now you have downgrades on the upper tranche.
It's going just the opposite, though. There's a tremendous pipeline building CBOs. It's just the opposite. The dealer community has come to us, has come to every firm in the street. As a matter of fact, we're thinking about one for the first time, because every Wall Street firm wants to do a CBO. It's just the opposite. There's a whole pipeline building for issuance in the marketplace, and raising the equity is going to be somewhat easy just because of where high yield levels are today. So I think it's a great positive factor, not a negative factor.
Well, I would agree that I think the opportunities are there for shrewd stock pickers, or bond pickers, but I think it's going to be much more difficult to raise the equity when people realize that the equity on the previous deals has been diminished, if not wiped out. I see that we're still in the down cycle of that. We're still, as Mike said, it's very difficult if you have to liquidate. The liquidation prices don't represent the fundamental values, but that's what happens when markets get to extremes.
Thank you. I have a forecast question for Morris and Teresa. You've been articulate about where rates are going in the relatively near future. But I wonder about, with all the factors you're looking at in the U.S. and in the world, if you could share with us any thoughts you might have as to where you think that the 10-year Treasury and 10-year good corporates in the U.S. might be 5 to 7 years from now.
Do you want to go first?
Because they were both rushing to speak first. I have my answer ready. I have my answer ready. I had a wise boss many, many years ago, and he said to me, Teresa, the one thing you need to remember about this business, forecasters come and go, analysts come and go, but man plans and God laughs. And so I think that it's going to be virtually impossible to predict that, what the level is. But I think that one thing we could predict much more accurately is that the capital structure will prosper, and that the capital structure will allow for debt. We are in a position today where debt is almost being squeezed out of the capital structure, where companies could just raise equity ad infinitum and dilute the equity ownership with bypassing the debt structure in the marketplace. That will not persist. There is an inherent corporate tax advantage for companies to issue debt, so debt will have its place in the capital structure, and debt will be rank ordered vis-a-vis Treasury. So my prediction would be that we will see a normalization, that the Treasury will be the benchmark for the prime borrowers, and that the corporates will stack themselves on top of that. Unlike what we have today, we have that wide diffusion of rates there. So we will see a normalization of the differences between debt and equity. We need debt in the capital structure. We cannot have companies subsist exclusively on selling IPOs and secondaries after that. So debt will resume a normal position, and debt returns will normalize to what I said they were the long-term 20 years. They will be a few percentage points below equities, and with leverage they can be raised to the level of equities. Whether we're talking about a 5% interest rate range or a 7% interest rate or a 10% interest rate range, it's amazing. I think just not that many years ago when we had Volcker at the Federal Reserve coming in for new tenure, we had, in 1980, we had short-term interest rates at 20.5%, and now we're screaming that 6.5% seems high. But I wouldn't venture to say where the Fed funds rate is or where the 10-year Treasury was, but I will venture to say that we will see that stacking, and we will see debt in the corporate capital structure.
You'll have a range of, say, 4 to 6.5%, 7% over the next 3-4 year period. The key phrase today is asset deflation. Nobody's really talked about that, but that's what's happening right now. It depends how long this asset deflation really endures. My best guess is that'll be with us for the next 12 to 18 months. You'll have 10-year treasuries below 4%. And it'll be a while before you get up to 6.5% on 10-year paper. But definitely the rate range, that's the range we've been in the last 5, 6, 8 years. So we've played around with the intermediates, that intermediate range for quite some time. And I think there are enough so-called governors or control type measurements in the economy so that you're never really going to have the excesses that you had. And unfortunately, we're in the business where most people predict off of the most historical, most recent past. And if this is one business, fortunately, where historical performance has zero predictive value. We're in this business, and I love it for that reason. Otherwise, a trained monkey could do it, and I hope I'm not that. But it's the fact that it's where each day you try to bring to your work, your profession, a little creativity and hopefully a little insight to kind of distinguish you from your professional peers. And so therefore, when you get into historical returns, I look at that stuff and I say, so what? It doesn't mean anything because it doesn't tell me about tomorrow. And that's what we're here for, to talk to you about tomorrow and to kind of assess what are the ingredients in the marketplace which make this a little different from the other experiences in the marketplace. So, and today we're in, I think, uncharted territory as to the mix. And that's what we're here to talk about. So, but I still think we're going to be in that range.
We have time for one more question. John? Yeah.
Since this is the last question, I want to walk a little bit away from finance, few days from Christmas, and ask Michael if it's a bit tricky, of course, if you put some kind of ethical component to your investment proposal, or do we expect to put children in the street, compliment of job people who may not do too much for them?
Well, that's actually It's actually a question I have already been asked. Whenever you buy any sort of debt that has a credit component to it, you're taking the risk that somebody's going to go out of business. And I think that in the case of home debt, you're talking about somebody possibly being moved out of their home. This is not a business where servicing these loans is not a business of knocking on the door late at night and evicting people. It's not to anyone's advantage for that to be the case. The servicers who service these assets have very high ethical standards and are actually rated by the rating agencies. And I think it's very important to do your research on those who service this paper, but they're all very well-known names. It's a job that needs to be done. It is not a job, by and large, that has anything to do with foreclosure and eviction. It's mostly collecting money that's due or past due and keeping the loans current. Defaults are now projected to be in the double-digit areas. Losses, still actual losses due to defaults, very low. And ultimately, that means that many of the homeowners, almost all of them, have not necessarily been wiped out. Some have to be relocated. We're talking about a relatively few amount of them, and I think it's done in a very ethical manner. But nonetheless, that is our system, that is the way of the world, unfortunately. I don't know. I think your hands are clean if you buy a security that you have taken part in any of this. Actually, I mean, this is, but that is the case.
Thank you very much, Morris, Teresa, Mike. Your comments are extremely insightful and informative.